Hi everybody. This is now week 5, and this is lecture for topic 5, part 1. Part 1 is supposed to be for this week. Next week, you will see another half of the of lecture for topic 5. I call it topic 5, part 2. Okay, so today is Monday, 15th of November. Starting from this week and starting from this topic, you will learn about accounting process. Accounting process is the steps that you have to do when you want to make accounting record for a business. Okay, let's see. Okay, if you have a business and then you want to make accounting record for that business, you have to follow accounting cycle. Okay, this is the easier way to understand accounting cycle. Remember this. You are learning about financial accounting. Financial accounting is the type of accounting that you can use to record business transaction and to calculate profit or loss for that business. Accounting cycle explains about the steps that you have to do when you want to make accounting record for a business. Accounting cycle contains 8 steps. The first step in the accounting cycle is to do analysis. It means that, let's say you have a business and then you have to do accounting record for this business. The first step that you have to do to make the accounting record is this step 1, which is doing the analysis. In step 1, doing the analysis means you have to identify the type of the business transaction, and then you have to show or to know the effect of the transaction on the accounting equation. It happened in your mind only. You when a transaction happen, you analyze. Okay, and then you do the step 2. Step 2 is to do journal entries. Journal is a book. It is the first book that you have to use in accounting. So step 1, you think or you analyze, and then you record the transaction in the journal. I will explain the detail in the later slides. So you record all transactions in the journal. Let's say you have a business, you started the business 1st of January 2021. So every time a transaction happen, you analyze. That is the first step. And then after you analyze, you record the transaction in the journal every day. At the end of the year, 31st of December 2021, you stop. And then you do step 3, which is preparing the ledger. So ledger is another book in accounting. So what you do in the ledger, there are many accounts. Most of the time we use T accounts. T account is like a section that you can use to record the transaction, and the shape is like capital T. Okay, so when you do step 3, you transfer all the journal entries that you have recorded in the journal to the ledger, to the accounts that you make in the ledger. After you have transferred all the transaction from journal to the T accounts, you have to close the T accounts, and then you have to calculate the balances for all the accounts. That is the step 3. After that, you do the step 4. The step 4 is preparing a trial balance. A trial balance is a list of all accounts that you have made in the ledger with their balances. There are many accounts. Account like cash, account receivable, supplies, inventories, account payable, account bank loan, account capital withdrawal, revenue, expenses, etc. So you have to list all these accounts in the trial balance with their balances. The purpose to list all these to prepare the trial balance is to check whether the recording process is correct or not. After you have prepared the trial balance, you have to do step 5, which is doing adjusting entries. The purpose of doing adjusting entries is to follow matching principle. I will explain about that in more detail in the later slides. After you have done the adjusting entries, you do step 6, which is preparing a new trial balance. It is called adjusted trial balance. This trial balance is a trial balance for the business after you have done the adjusting entries. When you have the adjusted trial balance, you can do step 7, which is preparing the financial statement of the business. In this course, the focus is you have to know how to prepare income statement, which is a statement that shows whether the business is making profit or loss, and also you have to know how to prepare a balance sheet. A balance sheet shows the financial condition of a business. That the financial statement is the final output of accounting, final output of financial accounting. The last step in the accounting cycle is closing entries. You have to do several I think you have to do several general journal entries, and then you have to prepare a closing trial balance. That's all for the step 8. So these are the steps in the accounting cycle. It is called accounting cycle because you have to do this 8 steps in one accounting year, and when a new year is started, you will have to do these steps all over again. Let's say you have a business, you want to do accounting record for year 2021, so you will start doing that from the beginning of the year. 31st of December 2021, you have to do up to step 8. When a new year started, when the year 2022 is started, you will have to do all the steps all over again. That's why it is called a cycle. So you do the same thing again and again and again. Okay, now we see the detail for every step. So topic 5, in this topic 5 you will learn from step 1 to step number 8. I have to explain everything quickly because this is the accounting process is there are many steps. You have seen there are 8 steps, and we have to cover all the steps in 2 weeks, this week and next week. So I will try to do the lecture quickly. So you have to read the textbook also in order for you to understand about the things covered in this topic. Okay, so this is step 1. Remember, the step 1 in the accounting cycle is doing analysis. So doing analysis means okay, something like this. So another point to remember is the accounting process, which is the process to make accounting record for a business, is started after the business makes a transaction. Okay. See, these are the examples of business transactions that I have mentioned. So, like I said earlier, the accounting process starts when a business or after a business does a transaction. So these are examples of transactions that a business will make. First, you see, buying something. A business purchase something or buy something. That is a transaction. A business sell something. That is also a transaction. A business pay wages or salaries to workers. That is a transaction. The business distribute earnings to owners. Pay taxes to government. Purchase land, building, and equipments. Well, these are all examples of business transaction. The business borrow and invest money. That is also a transaction. So the accounting record process is started after a business do a transaction. So let's say a business start operation at 1st of January 2021. On that day, the business purchase an asset. That is a transaction. And then the business will do more transactions. If the business is a big business, there are hundreds of transactions in a day, maybe more. Okay, so in this course you will learn how to do accounting record for a simple and small business. So don't worry, you can follow the process. And then in accounting, source documents are used as evidence that a transaction had happened. Source documents identify and describe transactions entering the accounting system. For example, bills from suppliers, sales receipts, checks, purchase orders, payroll records, bank statements. Okay, so in accounting, I have told you in the previous slide that a business will do many business transactions. And to know whether the transaction actually happened or not is by looking at the source document. Every time a business do a transaction, the business will prepare and maybe will get document from somewhere. The example is like this. Let's say a business sell something to a customer, then the business will prepare a receipt. That receipt shows that a sales transaction had happened. If the business purchase something from supplier, the business will receive receipt or invoice. Then that document shows the business transactions had happened. Every transaction does by a business will have document with it. So the document shows the transaction had actually happened. It is an evidence that a transaction had happened. In accounting, we record transaction that has document. Because if the transaction has no document, then we cannot say that the transaction is actually happened. Okay, so there are many types of source document. Here are 6 examples. Bills from suppliers. If you have a business, you purchase something from supplier in credit, the supplier will send bill. You will pay later. But if you purchase in cash, you will get receipt. And then checks. If you have a business, when you pay somebody, you will use check. The check has two parts. One part you will give to the person who you are paying, and a small part of the check is called check, but you will keep that. The check, but is an evidence that you have paid somebody. Purchase orders, payroll records, bank statements. Bank statements is a document prepared by bank. The bank documents, the bank statement shows cash in and cash out made by a business. Okay, and then remember, now you are learning about step 1 in the accounting cycle, which is analysis. In the analysis step, you have to know or identify the type of the transaction that happened, and the second thing is you have to know the effect of that transaction on the accounting equation. So what is the accounting equation? Accounting equation is this one. This is very important. You will use this equation in all the accounting process. So the equation is like this: assets of a business always equal to liabilities plus owner's equity. I hope you remember the definition of assets. Assets are resources owned by a business. Resources owned and controlled by a business. Liabilities are amount that a business has to pay in the future, or debts. Owner's equity is amount in the business that is owned by the owner of the business. Okay, the logic of this accounting equation is like this. If you go into a shop, everything that you can see is assets. For example, you enter a grocery shop. When you enter a grocery shop, everything that you can see, the furniture, the inventories, the equipment, everything, maybe the building also, and the land also, are assets. So let's say you enter a small grocery shop and you see everything, all the assets, and then you let's say the assets are $200,000. Okay, so and then a question arises, where these assets are coming from, how the business got the asset. So the logic is the business got the asset by using the amount invested by the owner of the business. When the owner of the business started the business, he or she maybe put $150,000 to start the business. That's how the business got the asset. The business used the $150,000 to purchase the asset. But when you check, the owner invested $150,000. The assets equal to $200,000. So there is a $50,000 difference. Where is this $50,000 coming from? It does not coming from the owner's investment, because the owner's investment is only $150,000. So the amount is coming from debts. The business maybe makes bank loan, or the business purchase some of the inventories and furniture and equipment in credit. The business takes the item first, later the business will pay. Okay, so that's the logic. Assets of a business always equal to the owner's equity. In our example, the assets are $200,000 and the owner's equity is $150,000, plus the liabilities. So if the owner's equity is 150,000, we know that the liabilities equal to 50,000. So that is always the case. When you see a business, all the assets of the business equal to liabilities or debts plus the owner's equity. Okay, this is what you have to do when you do the first step in the accounting cycle, the analysis. Okay, you have to know this. When a transaction happen, I said earlier, after a transaction happen, you have to analyze the transaction. That is the first step. So let's say now these are several examples of transaction. During the analysis, you have to know the type of the transaction, and then you have to know the effect of the transaction on the accounting equation. So let's say there is a business, and then the business borrow money from bank, $100,000. So how to analyze that transaction? You know that borrowing money from a bank is a transaction. So how to do the analysis? So first, you have to know or identify the type of the transaction. In this example, the transaction is borrow cash or money. Okay, that is the transaction. And then you have to know the effect of the transaction on the accounting equation. Okay, so the accounting equation is asset equal to liability plus owner's equity. So when a business borrow cash from bank 100,000, what do you think the effect of that on the accounting equation? Okay, what is the effect of that on the asset first? The asset will increase. The name of the asset is cash. The amount is $100,000. Why asset increase after a business borrow money from bank? The logic is like this. Imagine there is a business, and then one day the business borrow cash from a bank, $100,000. What happened to the business? Cash from bank goes into the business, $100,000. So that's why the first effect of that transaction is asset increases. The name of the asset is cash. The amount is $100,000. And then see this, what is the effect on the liability? Okay, see, at the same time, the liability of the business or debts of the business will also increase because the business borrow money from bank. So the second effect of that transaction is liability will increase or debt will increase. The name of the liability is bank loan. The amount is $100,000. And then there is no effect on owner's equity. The owner does not put anything to the business. Okay, no effect. Or the owner also does not take anything from the business. So the transaction of borrowing cash from bank will affect cash. There will be an increase in asset cash, 100,000. And the second effect is on the right side of the equation is liability will increase. The name of the liability is bank loan, and the amount is $100,000. The amount in the effect on the left side of the equation is same like the effect in the right side of the equation. If the left side of the equation increase, there will be also an increase in the right side of the equation. Okay, let's see the second effect. Okay, let's see. Okay, this is a second example. Let's say there is a business, and then one day the owner of the business put or invest something into the business. So let's say there's a business, and then the owner of the business one day invested or injected capital in the business. The amount is 200,000. Okay, so you imagine there is a business, and then there is the owner of the business. In accounting, remember, we have a principle says that in accounting, the business and the owner of the business are different entity. You do accounting record for the business. So one day, the owner of the business put $200,000 into the business. What will happen? The name of the transaction is the owner of the business invest in the business. So when the owner of the business put $200,000 into the business, what is the effect of that on the asset of the business? Cash is an asset. It is a resource owned and controlled by the business. So the effect is like this. When the owner of the business put 200,000 into the business, the asset will increase. The name of the asset is cash, and the amount is $200,000. That is the first effect. And then, is there any effect on the liability? Liability is the business debt, the amount that the business has to pay in the future. Is there any effect of that on the liability? No. The business does not owe anybody. But there is an effect on the owner's equity. The owner's equity will increase. Why? Because owner's equity is amount owned by the owner of the business in the business. So when the owner of the business put 200,000 into the business, asset cash will increase. At the same time, in the right side of the equation, the owner's equity, which is the amount owned by the owner of the business in the business, also will increase. In accounting, when a business owner investing something into the business or put something into the business, we record it in capital account. So owner's equity increase, the account is capital, the name of the account is capital, the amount is $200,000. That is the way to do the analysis step. Every time a transaction happen, you have to identify the type of the transaction and then the effect of that transaction on the accounting equation. So let's see another example. Okay, so the third example is, let's say the business pay bank loan $10,000. So see, the first example is the business borrow money from bank, and then the transaction number 3 here, we do an example. The business pay back the bank loan. Let's say the amount is $10,000. What do you think? Okay, the name of this transaction or the type of this transaction is business pay back a bank loan. So imagine there is a business, and then one day the business pay back a bank loan $10,000. So you can imagine when the business pay back the bank loan, there is a cash out. There is a cash goes out. The business has cash. The cash goes out from the business, goes out to the bank. $10,000. So what do you think the effect of that transaction on asset? The effect is asset decreases. Cash is the business asset. When it goes out, the cash decrease. So the asset decreases. The name of the asset is cash. The amount is $10,000. So that is the first effect of that transaction on asset. And then asset is in the left side of the accounting equation. So look at the right side of the accounting equation. What is the effect of that on the liability? Okay, so imagine the business pay back a bank loan $10,000, asset decreases, and then the second effect is, what is the effect on liability? effect on the liability is the liability also decreases because before the business pay back the bank loan is $100,000. In we make an example in the first example, the business borrow money from bank $100,000. So when the business pay back the bank loan $10,000, the liability, the bank loan decrease. The bank loan is a liability. So the effect of this transaction on liability is liability. The name of the liability or the name of the account is bank loan. Decrease. The amount is 10,000. Okay, and there is no effect of that transaction on the owner's equity. The owner of the business does not invest anything or take anything from the business. Okay. Now let's see. Example number 4. Okay, this is another type of transaction that can happen to a business. Let's say there is a business, and one day the business purchase an equipment. The price of the equipment is $5,000. So this is a transaction. The name of the transaction is purchase of equipment. You have identified the name. Now the second thing to do during the first step of the accounting cycle is to show or to know what is the effect of this transaction on the accounting equation. So what do you think? If a business purchase an equipment, what is the effect of that transaction on the asset? Imagine there is a business, and one day the business purchase an equipment. What will happen? The first thing that happen is when a business purchase an equipment, the business has to pay. Let's say the equipment is $5,000. So the business has to pay $5,000 to somebody. So imagine there is a business, cash goes out $5,000. So the first effect of this transaction on the accounting equation is asset cash decrease $5,000. That is when the business pay $5,000 to somebody. After the business pay that $5,000, the person, that somebody, will send the equipment to the business. So there is a business, equipment goes into the business, cash goes out $5,000, equipment with the value of $5,000 goes into the business. So the effect of that transaction is like this. Asset cash decrease $5,000. At the same time, asset equipment increase. The amount is $5,000. Okay. Is there any effect on liability? No, because we assume that the business purchased equipment in cash. Is there any effect on owner's equity? No, because the owner of the business does not put anything or take anything from the business. So that is the thing that can happen. Okay, the last example for doing analysis step is like this. Let's say there is a business, and then the business borrow fund or cash to settle a debt. It can happen. Some businesses, they have a debt that is due this month, for example, but they don't have cash to pay. So what they can do is they borrow cash from other sources to settle the debt. So this thing can happen. So if this thing happen, this transaction happen, what is the effect of that on the accounting equation? The effect is like this. When the business borrow from somebody, the liability will increase. And at the same time, the business use the amount borrowed to pay another debt. So the liability will decrease. So you have seen here there are 5 sample or examples of transaction, and how you can analyze the effect of that transaction on the accounting equation. You can see here, sometimes the effect of a transaction can be one effect in the left side of the equation and another one effect in the right side of the equation. Sometimes the effect can be two effects on the left side of the equation. For example, in the transaction number 4, the effect of that transaction is an increment in an increment in asset and also a decrement in the asset. It can happen like that. And then you can see in the example transaction number 5, that transaction, the effect of that transaction is two effect on the right side of the equation only. So if I give you a list of business transactions, make sure you know how to analyze the transactions. Okay, this is the way to analyze a business transaction. This is step 1 of the accounting cycle. It happened in your mind. Now, after the analysis step, you have to do the second step in the accounting cycle is to record the transaction in the journal. Journal is the first book that we use in accounting, or we call it a book of original entry, the first book that we record business transaction. Journalizing provides a chronological record of all business activities. It means that the record in the journal is in the chronological order. Chronological order means the record is in accordance with the time when the transaction happened. Imagine there is a book, you have to record all the transaction in the book. So every time a transaction happen, you write the record. So the first transaction that happened to the business will be written at the top of the book, at the top of the page, and then second transaction is after that. Third transaction is after that. So you can imagine in the journal, the records are in accordance with the time the transaction happened. It is in a chronological order. Okay, there are several types of journal. If you check the textbook, there are cash receipt journal, cash payment journal, sales journal, purchase journal, sales return journal, purchase return journal, and then we have a journal called general journal. In this course, you will learn about how to record all the transactions using general journal only, to make it easier. If you are an accounting student, you will have to know which transaction has to be recorded in sales journal, which transaction has to be recorded in the purchase journal, and which transaction have to be recorded in the cash receipt and cash payment journal. Accounting student will learn the detail, but for you, in this course, you will learn about how to record everything in the general journal only. Okay, before you can do accounting record in a journal, you have to know the rule of debit and credit. Okay, you have to remember this. Debit. Okay, debit means entries on the left. So if somebody said to you, debit the account, so it means that you have to record the transaction or the account in the left side. Credits. Credit means entries on the right side of the account. So if somebody said credit the account, so you know that you have to record on the right side of the account. Okay, this is the rule of debit and credit. This is very easy. You just have to memorize this rule. There is no other way. So see here. Okay, the rule is very easy. For asset, if there is an increase in asset, you have to debit the asset account. If there is a decrease in asset, you have to credit the asset account. So see here, there is a red arrow there. Asset increase, you debit or DR. Asset decrease, you credit. That's the way. If there is a decrease, if there is an increase in asset, then how to record that? You have to debit the asset account. Okay, for liabilities and honest equity, the rule is the opposite. For liabilities and honest equity, if the liabilities increases, you have to credit the liability account. If the liability is decreases, you have to debit the account. See, the rule is the opposite. The way to record liabilities is the opposite of the way to record the asset. Same goes to the honest equity. Increase in honest equity, you have to credit. Decrease in honest equity, you have to debit. Okay, this is another thing to remember. Remember this. Honest equity is related to at least 4 accounts. Honest equity is related to at least 4 accounts. The first account is capital. Capital account is used when the owner of the business put something into the business or invest something into the business. Let's say there is a business, and then one day the owner of the business put $200,000 cash to start the business. That amount has to be recorded in an account called capital. So capital account is related to honest equity of the business. The second account related to the honest equity is withdrawal or drawings. Withdrawal or drawings. You cannot see that in this slide, but there is an account called withdrawal or drawing. Withdrawal or drawing account is used when the owner of the business takes something from the business. The thing that can happen is like this. There is a business, and then one day the owner of the business needs cash urgently, $1,000. So he just go to the business cash register, and he takes $1,000 cash. So in that situation, you have to record that $1,000 taken by the owner of the business in an account called withdrawal or drawings account. When a business owner invested something into the business, the owner's equity will increase. So you have to credit the account, capital. When an owner of a business takes something from the business, for example, take $1,000 cash from the business, the owner's equity will decrease. So you have to debit the drawings or withdrawal account. Why you debit? Because there is a decrease in the owner's equity. And revenue and expenses. Okay, so the thing is like this. if there is a business, the business is owned by the owner of the business. Okay, the business owner will invested like $200,000 to start the business. Maybe more, maybe less. But our example is $200,000. So the logic is like this. A business is owned by the owner of the business. If the business makes profit, then the profit belongs to or owned by the owner of the business. So if a business makes profit, the owner's equity will increase. But if the business is making loss, the owner's equity will decrease. Okay, so how to calculate profit? In accounting, the basic way to calculate profit is revenue minus expenses. So that's why revenue account and expenses account are related to owner's equity, because revenue and expenses determine whether the business is making profit or loss. So these two accounts are related to owner's equity. Revenue, if there is an increase in revenue, the business will make profit. So an increment in revenue means an increment also in the owner's equity. That's why in accounting, when you want to record the revenue, you have to credit the account revenue. Credit means the owner's equity will increase. But expenses is the opposite. If a business makes expenses, the profit of the business will decrease. When the profit of the business decreases, the owner's equity will also decreases. So for that reason, when you record expenses, you have to debit the account. Debit is debit entry in the expenses account shows decrements in the owner's equity. Okay, you have to memorize this rule first, and later you will slowly understand the logic. Okay, these are common account names. In accounting, we record transactions in accounts. Okay, see here, current assets. There are three main types of accounts: asset, liability, and owner's equity. So you can see here, for assets, accounts that are related to assets are cash, account receivable, inventory, and supplies. Everybody knows cash. If there is a business, the business must have cash. So cash is an asset. Account receivable is something like this. There is a business, and then one day a customer come and the customer purchase something, $50. And then the customer say he will pay that $50 at the end of the month. So in accounting, when a customer will pay something later, the amount has to be recorded in account receivable. That amount is account receivable records something that the business will receive from customer from in the future. So account receivable. Inventory is also an asset. It is an asset account. Inventory are things that a business sell. Let's say you see a grocery shop. All the things that the grocery shop sells, like rice, sugar, flour, biscuits, breads, etc. These things are called inventory. In accounting, we call them inventories. They are things that are sold by a business. Supplies. Inventories are asset. Supplies is something like this. There is a business, and then when the business is in operation, the business use things to do the operation. So these things are called supplies in accounting. A simple example is like this: you have a laundry shop. When you provide laundry services, the shop does not sell anything, but when you provide laundry services, when the shop provide laundry services, the shop has to use detergents, softeners, what else? Detergent and softeners. These things, detergent and softeners, they are called supplies in accounting. The business does not sell detergents and softeners, but the laundry business use the detergent and softeners to when the business provide the services. There are also non-current assets like land, building, furniture, and equipments. They are all assets. You have to have a land and an account for land, an account for building, an account for furniture, and an account for equipment. Current liabilities. A business will have several current liabilities. For example, account payable. Account payable is something like this. A business, let's say there is a business, and then one day the business purchase something from supplier. But the business take the item first, but will pay later. The amount that the business owe to the supplier is recorded in account payable. So in accounting, we do that. Salaries payable. Salaries payable is something like this. There is a business. The business has several workers. In the month of November, let's say, in the month of November, the workers has worked in the month of November, but the business will pay the workers at the early of December. So the amount of salaries that is still unpaid to the workers is recorded in the salaries payable account. Overdraft is a short-term bank borrowing made by a business. It will have to be recorded in an overdraft account. And interest payable. The situation is like this. There is a business. The business borrow money from bank. This month, the bank charge $100 interest for the borrowing. So that interest is still unpaid. If the interest is still unpaid, then in accounting, you have to record that in the interest payable account. But if the interest is paid, you record in the interest expense account. Okay. Long-term liabilities, long-term loan is also an account. Equity, remember, equity. There is account capital related to equity, and another one is drawings or withdrawal. Retained earnings is an account that record the amount of profit made by the business from the previous year. If you have to know about this, I will explain about this more in the later chapters maybe. And then another common account names is sales or revenue. This account is used to record the revenue of a business. Some businesses they got revenue from selling things like grocery shop, supermarket, factory, etc. But some businesses they got revenue from providing services like clinics, laundry shop, what else? Like AirAsia, they does not sell any. AirAsia does not sell anything, but provide airline service. So service businesses They got revenue from providing services. Expenses. Okay, if you have a business, you will have to pay many expenses. For example, salaries expense, rent expense, advertising expense, transportation expense, utilities, and accounting fees. If you have a business, if you an owner of a business, most of the time you are very busy. You do not have time to do the accounting record by yourself because you are busy with managing the business. You have to manage the inventory, you have to manage the workers, you have to manage the marketing, etc. So most of the time businesses, they hire people to do the accounting record. They hire accountants to do the accounting record. The amount that they pay to the accountants is called accounting fees. That is an expenses. That is an expense for a business. Okay, like I said earlier, in this course you will learn about how to record business transaction in the general journal. Okay, this is the format of a general journal. Of a general journal entry. So first, see the yellow box here. First, for when every time you want to record a transaction in the general journal, the first thing that you have to write is the date. See the first thing in the left side of the box. You have to write the date, and then you have to show the debit entry or the account that you are debited, and then the XX there in the yellow box is the amount related to the account. The second thing is you have to write the credit entry or the account that you have credited, and then you have to show the amount related to the account, the XX. You have to remember that when you write the credit entry, you have to write it a bit in the right. So debit entry is a bit in the left, the credit entry is a bit in the right. And then the last thing that you have to write is the explanation about the transaction. Okay, this is the first part of the lecture. I will share with you the second part of the lecture today. Do not forget to write your name and metric number in the comment section of this video. I will record that as your lecture attendance. Thank you very much.